Hello everyone, and welcome to September's Pensionmark webinar, where we'll be discussing market volatility through a market intelligence outlook. We appreciate all of you taking the time to join us today. A few items to go over before we get started. First, in order to ensure everyone has the ability to hear the information presented by our guest speaker, everyone will be on mute during the webinar. Second, please feel free to write in any questions you have using the Q&A tool on the webinar menu. At the end of the webinar, we will take the time to go through these together. Third, there will be polling questions throughout today's webinar. All results are anonymous, and we appreciate your participation. Now, I'd like to introduce our guest speaker of John Hancock, Matt Miskin. Matt is a senior capital markets research analyst where he focuses on capital markets research. His primary role is to analyze and synthesize macroeconomic, fundamental, and technical research from top-tier independent investment strategists. With strategist and asset manager insight, he leads the development of John Hancock's investment quarterly market outlook, Market Intelligence. Matt received a Bachelor of Science degree in Finance from Elon University and an MBA from Babson College. He has completed Level 2 of the CFA program and holds his Series 7, 66, and 24 licenses. Thank you for presenting today, Matt, and now I'll turn it over to you.
Thanks so much, and thanks everyone for being here with us. Throughout the course of this presentation here, we'll be reviewing our Market Intelligence publication. It's a quarterly piece that we put together from John Hancock. It's available on our website, jhinvestments.com. The new one will be coming out here in a couple weeks as we look into the final quarter of the year. What we'll be talking about is the third quarter piece, but I'm going to be providing updates, real-time updates to the charts and views across the publication, and also be weaving in volatility and discuss specifically how volatility ties in to a lot of these views. So in terms of the structure of the presentation, first we're going to be talking about key macro themes that we're hearing from our asset management network and the strategists that we work with to gain insight into the markets. Then we'll go into traditional asset classes, think U.S. equities, international equities, and fixed income, and then conclude with some portfolio considerations that you could think about in terms of putting together your 401ks or your investment accounts. All right, we have here our first polling question though, and for those out there, this is a question to you. I have investing experience with stocks, bonds, and international investments, and I'm aware of the risks associated with each. Please select one, so true or false. And I'm going to give here about a minute to go ahead and submit true or false on this one. And we should be tallying those up here. All right, so 63% true, 37% false. So a couple things to think about here. One, I have over a decade of experience in investing and also a mix here of managing client capital in discretionary portfolios, but also in capital markets research and forecasting asset class returns. And I would say that I'm still learning of all the risks associated with all of these and how the market dynamics continue to evolve in the years of my experience. So, you know, I think even those that did say true, I'm sure there's some things within this presentation that will be new and will be something educational that can help inform you in making investment decisions. And for those that said false, we'll give you plenty of content that will help you in your investment decision making. All right, with that, so let's go to the next page here and talk about the key macro themes. So these are things that at a high level we believe are navigating the global markets. The first one is oil lower for longer. So lower oil prices. In 2014, oil was about $100 a barrel. As of this presentation, we're at $45.65 on WTI. This has implications across countries, country economies, the U.S. included. The U.S. went through an energy renaissance here in the last decade, becoming a major producer in the world. And lower oil prices is changing the dynamics of the global marketplace. It also has impacts on risk assets and earnings capability of corporations in the oil space. And we'll talk about that. The U.S. dollar staying strong. So one of the big things here is if you think about investing internationally, whether that's through equity exposure, meaning you're buying stocks in international countries, the dollar being strong is going to have an impact on your returns. That's part of actually in the prior polling question, are you aware of some of the risks of international investing? The dollar and currency fluctuation can be a key input there. We're going to talk about that in more detail. And then monetary policy still steering. The Fed is likely the most important organization or leading party here in the global marketplace. So dictating risk sentiment, dictating how markets are reacting to different data. The Fed is so important, and in the marketplace I would argue is equally or if not more important than the president. Although that sounds a little controversial here, as all this headlines around the presidential election, the Fed is having more of a direct impact in what you can see in your returns, likely in your 401k, and we want to talk about that. All right. So the first one here we'd like to start with is U.S. equities, and I want to just talk about quickly how this book is created. So within the left-hand side is the key macro themes and how that ties into the U.S. equity asset class, so stocks within the U.S. On the right-hand side is views of our asset management network. The way we come about arriving at a view is we go out and we ask some of the smartest, in our opinion, asset managers and best asset managers in the world that we have in our investment lineup. We also invest heavily in third-party research, so we go to unbiased third parties that are strategists that do a lot of top-down macro research, looking at the economy, looking at the Fed, looking at the presidential election, geopolitical risks, so on and so forth, and we ask them and monitor their investing to come at where their views lie. Bearish meaning they're believing that the U.S. equity market, for example, is going to go down or is going to underperform. Bullish, all the way to the right, would mean that the U.S. equity market's going to go up or outperform. And what you can see is the concentration of views is neutral. So what does this mean as an investor? This means that if you think about your time horizon, your risk tolerance, your return objective, your liquidity constraints, all the things that you kind of think about when you're putting together your portfolio for your 401k or your investment accounts, we would have a policy weighting, meaning that using all those inputs to arrive at your U.S. equity allocation, we would hold that U.S. equity allocation currently, given our outlook, given what we're seeing in the markets, and not to overweight it, being too greedy, if you will, or underweight it, or being too fearful. A lot of times people think about fear and greed in investing, and so we would make sure to be in line with your target and be neutral. Then under that, it's large cap versus small cap, more overweight large versus small, and then growth versus value, growth stocks versus value stocks, we're neutral there as well. Let's get into some of the things that are driving that decision. So this is the first one, and if there's one slide that I really want everybody to take something away from, this is it. And it's the leading economic indicators. And if you think about it, if we're not going into a recession, then you should likely hold stocks. Stocks tend to do well in periods removing recessions. I mean, this isn't very, it's nothing new probably to many of you. If you knew that we weren't going to go into recession, then you would probably hold stocks. If you knew we were going into a recession, on the other hand, you probably wouldn't. There is no perfect magic crystal ball to know if we're going into a recession or not, but we have found this to be as good as it gets. And what this shows is there's 10 different indicators that roll up into this leading economic indicator index. The indicators are actually listed below in this table. And the Conference Board, who's this third-party objective, it's spun out of a government entity, actually. Think of it kind of like a think tank. Comes up with this index, and it goes back to the 1950s, and it's accurately foretold the last 7 recessions. Basically what's happened is there's been green bars in expansionary periods, but then there's blue bars in contractionary periods, and as long as there's about 3 to 5 blue bars, then recessions have then happened in the last 7 instances. This goes back to 2000s. It shows that the last 2 recessions, it turned negative before a recession happened. If you go to the right-hand side of this chart, you could see that 1, it's decelerating, so that's not a great sign. But 2, it is still positive. And what you can see is actually in 2012, it did something similar. From 2010 to 2012, it went down, flatlined, bottomed, moved a little bit higher. So what we're hearing from our network and the analysis that this would provide is that we are likely not going to see a recession because it is still positive, but that the economy is slowing and that it is trending lower. So it's more of a muted growth type environment, but not a recessionary one. And that's a huge reason why we're neutral U.S. equities. We're not seeing huge growth here, but we're not seeing a recession either, so it should be a part of your portfolio. All right, next polling question. With the elections nearing, how likely are you to make changes to your portfolio based on the outcome? I talked about the Fed a little bit and the presidential election, but we're going to talk about it a little more. But we first like to hear your input. So if you could answer here, very likely, not sure, I will maintain the same portfolio and remain diversified. And we'll give you 1 minute here to go ahead and answer on that. All right, let's see. Wow, okay. So 6% very likely, and there are geopolitical strategists in our network that we are talking to that are raising some cautionary flags. The Brexit vote earlier this year was one that their polls said that it was going to not happen, and it did happen. So polling can be very difficult, and strategists try to publish research to make assumptions on outcomes, and some of them do try to make asset allocation decisions around that. 39% not sure, totally understandable. And then 56%, I'll maintain same portfolio and remain diversified. Okay, that's probably what our base case assumption or what we would actually implement. But let's talk about why that is. All right. On this next slide, so the elections are likely going to cause a lot of policy uncertainty. And one of the things we looked at was an economic policy uncertainty index. So that's the blue line on this. And what we did was we used labels here to show all the times where this economic policy uncertainty index spiked. And what's not surprising is that, and sometimes you got to kind of go back and just put this in context, since the Great Recession in 2008, policy uncertainty has been plaguing this market environment the whole time. We've had double-dip growth scares, QE2, so the Fed's been in the marketplace doing QE, quantitative easing, debt ceiling dispute. So that was in 2011. The government was going to shut down. Turns out they actually did for some period. President Obama, so we've already had one election period, and it was a relatively tight one at some points. More QE3, fiscal cliff, the government basically shutting down incredibly. There's been international scares. Think about China's currency devaluation last year at this time and how that shook the markets. And then Brexit, just as of late. So to say that this election period and thinking about November as really this, we haven't seen anything like it or it's anomaly, it really isn't. It feels like it some days with all the press out there, but there's been plenty of times throughout this cycle and since the Great Recession that we've had plenty of uncertainty. We also, on the purple line is the VIX index. That's a measure of volatility. It's a market-based index, and it often does spike in periods of these uncertainty. Sometimes it spikes so quickly and comes back down that you don't even see it on the radar. It's actually on a monthly basis on this chart. In Brexit, it spiked for a week and then came crashing back down. It's amazing how quickly these fear events can happen and add volatility to the markets, but then people become rational again and then get back into the market and things work themselves out. In the back here, and it's in the light blue shading, is the S&P 500 over that time, over this, all these things happening. If you invested $100,000 back in 2009, it'd be worth $264,000 today if you invest in the S&P 500 and you live through all these things happening. And so what we're hearing is that U.S. equities will likely take their guidance from the underlying health of the U.S. economy, confidence in business, and just to follow through and if the Fed ends up being patient and not tightening lending standards, that U.S. stocks could keep moving higher, and that the presidential election might give you more of a head fake, similar to the Brexit vote, than anything else, and probably does not warrant changing your allocation to U.S. equities. All right. So another thing, though, to think about is actually underlying corporate fundamentals. So in terms of the top down, we don't see a recession. We don't think the presidential election is going to be a huge shift for your asset allocation, and that U.S. equities will do okay. The thing that we're watching, though, is actually corporate profitability. And one of the things we talked about at the beginning was that oil companies or energy companies that are doing exploration and production or are tied to the price of oil are really struggling right now. And what this chart actually shows is the net income of all the companies in the S&P 500, and they're broken out by actually their sector. So what part of the the business environment they're in. And energy companies were making about $100 billion per annum, and for a nice steady period throughout this cycle. And when oil tumbled, they really struggled. They couldn't cut costs quick enough, and they still have a lot of infrastructure, and they can't necessarily make their profits back to what they had. So energy companies are losing about $70 billion per year right now in aggregate. And so that's pulling down the overall S&P 500's net income, if you want to think about it as profits or earnings. So that's a tough hole to dig out of, and that's something that is a cautionary tale that we're hearing from the asset managers and those that are top-down strategists, because without profits steadily rising for overall business, it's hard for stock prices to keep moving higher. So stock prices over the long term tend to follow profits. And with profits falling since 2014, that makes it hard for stock prices to move meaningfully higher off this kind of backdrop. The other point, though, is that there are sectors that are doing okay, and when you actually use a valuation lens to look at them, there's some places we think offer attractive opportunities. In this chart, what we show On the vertical axis is a forecasted earnings growth, a long-term earnings growth. This is based on bottom-up analyst expectations of earnings growth for different sectors. And then the price to earnings multiple. Think about price to earnings multiple as, it's just the same as a price of any asset. And then earnings is the cash flow stream that you are, or earnings stream you get for that. You want to buy with as low a price to earnings multiple as possible. A higher price to earnings multiple would mean it's more expensive on a relative basis. And so you want to buy things on the left-hand side of this chart. You want to be in the upper left as much as possible. But if you think about it, in terms of where our asset managers are finding opportunities, it is these sectors that have lower price to earnings multiples for the most part and higher earnings growth forecasts. And those are in the financial sector, healthcare, technology, and consumer discretionary. The places they're not finding as many opportunities are telecommunications, utilities, and staples. So just something to think about in terms of if you're owning a fund or if you're owning an index, you might have different exposure to these sectors, and it's just something you want to monitor because your starting valuation and the potential growth prospects can help influence your future-looking returns. All right. The last page of this section is talking about valuations in a little more detail in terms of the overall market. So I just talked about price to earnings multiple. So that is referenced here on the top chart. Price to earning multiples since 2014 have ranged from about 16 times to as high as, if you continued this chart, it'd be all the way to 21 times earnings. So 21 is higher, and it's not as comfortable as a place to be because that means things are more expensive. At 16, that would be a less expensive place, and you can see there's been times where 16 has been a support, where then multiples have gone up higher, meaning that the price has dragged that up. So things are kind of expensive on an aggregate basis on a P, looking at PEs for the S&P 500. If you go to the bottom panel here, there's three things that kind of make up your forward-looking returns, and we looked at them back just a couple of years here. So 2014, there was 6% EPS growth. So earnings grew 6% year over year, which is great. You got multiple expansions, so this chart kind of had shown that, but that means that 5% of your return was from just multiple. You bought at 1 PE and it got to a higher PE, so you got 5% return on that. And then your dividend yield. Over the long term, your dividend yield can be a huge tailwind to your returns if you reinvest, or if you just even kick it out. It's a return for your holding of equities. But it's been it's about 2% per annum return. 2015 was a different story. So 2015, earnings growth actually fell, and we're seeing that a bit here in 2016 if you updated this data. PE multiple expansion was minimal, and you basically got your dividends. The S&P returned about 1.4%. So that was a very low return environment last year. This year, the market's up about 9%. S&P 500 through yesterday, it's up just over 8% total return. And what this is, it's a little bit of dividends. Earnings growth is actually negative. You updated this through today, and it's all been multiple expansion. If you look at the top clip, it started the year about 18, it's gone to about 20. So it's all been multiple expansion. And what we're cautious about is we can't just rely on things getting more expensive forever. That's really kind of what happened at the end of the tech bubble. Things just got more and more expensive, and that didn't end well. So that's another reason why we're not getting more greedy here, and we're more neutral. We still think that earnings can come through at a modest pace and be positive. We think dividends can help us get a positive return, and that we don't need to rely on multiples for everything. It might just be a slow growth environment where we see kind of a 4 to 6% return, with dividends being almost a third or half of that return. So that's kind of what we're looking at for U.S. equities. All right, turning to international equities. International equities, we have, again, the left-hand side is the macro themes. On the right-hand side, we have the views from our network. So we're neutral here as well. So we would hold international equities in a portfolio. They do carry a little bit more risk. And typically investors have a bit of a home bias, meaning they're having a little bit more U.S. than international. That's fine. But it's just another asset class that you want to consider for your investment accounts. All right. So one of the big things in international equities is their central bank is doing everything they can to support the market. We talked a little bit about the Fed. The Fed could be raising rates here in December, and I'll talk about that in a little more detail. But the ECB, the European Central Bank, is doing everything it can to inflate asset prices, to help the economy. And what this also helps do is it helps support risk assets. If you have a central bank that's buying financial assets in the marketplace, that's a supportive buyer for risk assets. And with the Brexit situation, we saw that European and UK equities fell the couple days following Brexit, but then they bounced back. And that just shows the strength of a central bank that comes out and says, we'll do whatever it takes to support financial assets, to create liquidity in the market, and that's been supportive. So that's one of the key reasons we do like international equities. Another thing that is positive for international equities is there's a reversion potential. So this chart shows the MSCI EAFE relative to the S&P 500. And what you can see here is the light blue is actually the MSCI EAFE underperforming in the bottom part, and the top part is the MSCI EAFE outperforming. So EAFE, meaning EAFE is a international developed benchmark, which has, or index, which has a meaningful allocation to European equities. It also has Japanese equities. Canada, Australia is also in there. But what happens is it's cyclical, right? So in the green, you could see it outperformed, and then the light blue would mean that the U.S. outperformed, and you go left to right. So international developed equities outperformed, and then they underperformed. They meaningfully outperformed in the 80s, and then they underperformed in the 90s. And then they underperformed in the 90s, and then they outperformed in the 2000s. Now that was 2000 to 2008. Then you take this cycle, and the U.S. equity market's outperforming again. So the light blue, meaning that U.S. is outperforming EAFE. And what has happened is now it's the longest period in history. So we're looking at a reversion opportunity. It's been 105 months of underperformance of international equities relative to U.S. equities. And that just doesn't seem, if you look at history, to happen forever. And that these things happen in cycles, markets happen in cycles, and that eventually international equities are going to revert. On the right-hand side, we also show valuations. We talked about PEs of the U.S. equity market being expensive. International equities on a relative basis look more attractive. So they have lower PE ratios, price to earnings ratios, and higher dividend yields. So we talked about dividends being a key component of your long-term returns. Dividend yields of international equities are double that in many cases, or at least 50% greater than that of the U.S. And if you're thinking about your long-term returns, those dividends are going to be hugely important as a tailwind for helping you out in getting those returns. All right. The next slide here is something to consider for currency. So I know there was an international risk question. It was also part of our, the dollar being strong was a major macro theme. So a lot of, as investors, there are hedged products, meaning that you are taking currency out of your investment in a foreign equity basket or foreign stocks if you want to remove the currency exposure or the volatility of the currency, you would hedge it. Now, there's a cost to that, but that's another way of investing in international equities. If you unhedge it, which would be the bottom part of this chart, there can be volatility. You can benefit or you can lose from the currency appreciating or depreciating. So relative to your currency, which would be ours of the US dollar. So what this shows is, this is rolling 10-year data, meaning if you invested at any data point since the 1970s, it really goes all the way to the 1980s as endpoints. But there's periods where hedging your currency against the dollar have worked. So the light blue would be periods where, hey, it's working to be hedged. It's outperforming unhedged. And this most recent data point, there's been a nice little run here where the dollar's actually strengthened and international currencies have depreciated. So where you're taking those currencies back and you're translating them back to your portfolio, it's actually been a negative impact to your international exposure. But if you look over history, these periods tend to be pretty small, and currency actually has tended to be a benefit for investors over the longer term. The dollar is actually weakened over the longer term against other currencies. And so our perspective is that hedging isn't actually an effective strategy over the longer term, and we would prefer to be unhedged. But it's also a risk to consider, and just also something to consider for your international equity exposure. All right. With that, now we're going to go to fixed income. And I do want to say that fixed income is probably going to be the most important part of your portfolios as you think about retirement someday. You're going to end up allocating greater parts of your portfolio, most likely, if you think about a target date or a some sort of asset allocation mix, that as you get closer to when you actually need the assets and the cash flows of those assets, you're going to want to be more conservative, and therefore your allocation to fixed income is likely to be higher. The problem is that the fixed income markets are extremely low yielding right now, and it's hard to get returns there. So parts of the market that we do like is U.S. high yield. We're tapering that a little bit here in the next book, so we'll say that it should be more on your policy weight in our view, and that investment grade corporates are something that we do like. Overall, again, we would be at your policy weight of fixed income. The reason why is because it is a nice buffer in backdrops of volatility, and we think that they could come in very important for your asset allocation. So the first chart here is talking about those low yields. We're in unprecedented times today in that there are negative yielding bonds. Logically, this makes no sense, and academically speaking, there hasn't been any precedent for this. So basically, people are paying for someone to hold their money. Logically, you would say, well, why don't they just put their money in a safe or under their mattress? And that would make sense. But nonetheless, what's happening is that that's happening, and central banks are causing this to happen. They're actually buying these bonds and creating a negative yield. If you look at Germany, Switzerland on this chart. Japan over on the right is also a negative yielding bond. These are huge fixed income markets on the global capital markets landscape. There are other places, though, that have positive yields. You look at the U.S., we're at 1.5. As of right now, we're at 1.54 on the 10-year Treasury. So this is 10-year yields globally. The other thing you'll see is that we color-coded these based on their credit rating. So the lower the credit rating, that typically means lower, the higher the risk. So if you have below triple B, or you can see here 3 Bs in a row, that would be below investment grade. The higher the credit quality, the more green. AAA is the best you can be. And on this, B is the lowest. You could be below B, but we're not going to go there. So what you can see is that there are places where there are yield. Brazil, a 10% yield. Russia, 8%. There, you could go to Greece and you could invest and get probably an 8% yield. The problem is that you have to take a lot of risk to get those yields. So with this backdrop, we believe that there are opportunities globally for fixed income strategies that have flexible mandates. You can think about it as strategic income. There's a lot of bond strategy, the title of the strategy will just be bond. And it gives a manager a little latitude to go out globally and find opportunities. And we, at least for strategies that we look at and we're leveraging, are considering risk as well. So you got to know what you own. But we do think that there are managers that can add value in looking at this landscape. We got to talk about the Fed, right? And especially in terms of fixed income. And one thing that, going into the year and 2013 was, everybody was talking about it, was this fear of the Fed's going to raise rates and it's going to really hurt the bond market. You're going to get major volatility in the bond market. And, it hasn't really played out that way. Last year, the Fed raised rates for the first time, and it was a 25 basis point move. And this year, they have not raised rates at all. Just here in September, they decided not to. Our network is forecasting December this year. And what we're trying to outline here, the Fed, when they come out every quarter, they give this summary of economic projections. And they try to tell you, hey, this is what we think rates are going to be over the next 3 years or so. And what they're saying is that things are going to be very slow in terms of how fast we raise rates. And it's gotten slower and slower and slower every time they give a new quarterly update. This most recent one, they're thinking 1 rate hike this year, and then 1 to 2 next year, and 2 or so the following year. So this very slow rate hike type environment is only going to be a modest headwind to bonds. If your duration risk or your risk of interest rates rising in your fixed income portfolio, with a 1 rate hike a year, it'll trim your returns, but it's not going to be as much volatility as the last cycle where Greenspan raised interest rates every single meeting and rates moved pretty quickly higher. This is kind of a new normal, is what some people have called it, in that rates are rising at a very slow pace. And it means that it's okay to own bonds, and that you're likely to see low returns, but you're not going to see this kind of bloodbath that many had feared a couple years ago. All right, a couple other things here in terms of bonds. So one thing you can think about is yield. So yield's pretty much, over the long term, your starting yield explains majority of your returns. And intuitively this makes some sense in that if you own a bond and it doesn't default and you own it to maturity, then you should get the coupon. Most high quality bonds, that's the way it plays out. Within owning that bond though, if rates rise, they have interest rate risk, so the price would actually go down. And what we're seeing is that, again, we're not seeing rates moving meaningfully higher. And the reason why is we're seeing factors that are pushing rates down and factors that are modestly pushing rates up, but they're not pushing them meaningfully higher. So some of the things that are pushing rates down. One, U.S. bonds look great relative to other bonds internationally that are negative yielding. So people are drawn to U.S. Treasury bonds. You're seeing a low growth environment, so that's actually meaning that bonds, from a macro perspective, are an attractive asset class. In a high growth environment, bonds tend to do less well. In a low growth environment or deflationary environment, bonds actually do better. So these are all things that keeping yields lower, which means that bond prices remain less volatile and can actually stay where they are. There are factors pushing rates up, which mean that they could push bond prices down. So there, in terms of inflation, core CPI, this was as of May, the most recent reading here in August was actually 2.3%. Healthcare costs and shelter, or if you think about housing prices and rental equivalent, it's ticking up, and it's meaningfully, you're seeing some inflationary pressures there, particularly in healthcare costs. So those things are are creating inflation, and it's making bonds a less attractive asset class. The jobs market's doing pretty well. There's a lot of job openings, and over the last year there's been plenty of jobs that have been created. And then average hourly earnings. They're not accelerating meaningfully, but they are ticking up in the 2% proximity, and that eventually should lead to inflationary pressures. So these are some of the things to consider. We are saying that you're going to get this range-bound environment, and that you're just not going to see huge losses in your bond portfolio as a result. So some other things to think about in terms of overall fixed income and where to invest potentially across asset classes. So like in equities or stocks, you can go to different sectors. There's different bond asset classes that you can consider investing in. So one is high yield. And at this chart, what you can see here is on the vertical axis, what we have is we have yield, your starting yield, which as I mentioned earlier is most likely your total return over the long term. But then you also have here is your correlation to stocks. So 0.8 meaning that you have a very high correlation to stocks, negative 0.7 meaning that they actually move the opposite way of stocks. And this is something to think about for building your overall asset allocation or your portfolios and your investment accounts, is that certain bond asset classes you own, they can go down when stocks go down, and they're not adding a lot of diversification benefits. That being said, they can offer return potential. So let's start with high yield. High yield, this actually come down since then. It's now about here. It's about 6%. But we said at the beginning that we're kind of looking at, let's say, a mid single-digit type return environment to, just over 10% would be amazing, but we'd have to watch multiples. If high yield's yielding about 6 and we don't see a recession, that can be an attractive return enhancer to portfolios. Of course, you have to consider the risk. It's a more volatile asset class, and it acts a lot like equities. So something to consider there. The other part of this is investment-grade corporate bonds. Investment-grade corporate bonds have little correlation to bonds in terms of this concept of, at least with treasury bonds, but they also have little correlation to stocks. So they're kind of in the middle here. And that's an attractive place to be for diversification benefits. They also have a starting yield, this has come down again, starting yield, let's say, of 2 to 3%, which doesn't sound great, but they've got lower volatility. And so what we're saying here is within a portfolio of fixed income, having this as your core, and in some of these higher yielding assets to roll, to add to that, to add return potential, we think makes a lot of sense. Now, treasuries are the best place to be in a risk-off environment, in an equity drawdown, and we would own some of these higher quality assets within the fixed income market just as your protection. Now, they're very low returning, and we would be underweight relative to kind of a multi-asset portfolio, but nonetheless, that's where you want to go for protection. All right, couple last slides here. One is, we talked a lot about valuations. Both stocks and bonds are pretty expensive. This is the forward PE ratios here on the vertical axis. This is their 10-year range. And then you have the median. The dots are showing last quarter, this quarter. And it has it across different equity asset classes here. And what you can see is basically everything's expensive. A couple places look less expensive on a relative basis compared to U.S. stocks, and that's international equities, but still expensive relative to the average that they've traded at over the last 10 years. Yields are another way to think about valuations for bonds, and this is the 10-year range again. The lower the yield, meaning the more expensive. So U.S. bonds, expensive. Treasury bonds, expensive. Corporate bonds, expensive. High yield looked a little more attractive. This has come down, though. This is down around here as of today. So even high yield looks expensive now. So what does this mean? stocks and bonds are both relatively expensive, and it might be worth considering other asset classes that you can find that have lower correlation to these two things that might give you different return potential. You know, it depends on what's available through your investment accounts, but something to think about if you're trying to find other ways to generate returns. Okay. Two final things here to wrap up. One is volatility. This is a chart of the VIX index, meaning that volatility index, and it has actually gone up during Brexit, but it's come back down. In September, it's come back up a little bit, and the dollar has actually come down a little bit, but is still elevated. So something to watch out for is the dollar and volatility. If dollar continues to strengthen, we would expect volatility to go up, and to just be cautious about taking too much risk, being too greedy in this type of environment. We don't want to be fearful either, but nonetheless, that's something to think about. So if this plays out, some things to own, going back to those high quality bonds, investment grade corporate bonds, that's something you'd want to have in your portfolio. And then if you do think about alternatives, I'm not going to spend a lot of time there, but try to think about things that add diversification to your portfolios or have a lower risk. So you got to do your homework on those to find out if they have lower risk than the things that you already have. And then the other thing is these bouts of volatility. In the beginning, I talked about geopolitical uncertainty and how a lot of times things get really ugly for a week or so and markets drop, but then they bounce back. Sometimes you can use them as opportunities. You can find stocks or bonds to add to your portfolio in periods of volatility. And if you have a long enough time horizon, you know, that could actually work out in your favor. The final thing is inflation. So as you're thinking about retiring someday, you want to think about your purchasing power parity, meaning, you know, can you spend the same amount with the money you're earning today? Inflation erodes basically the assets you're making or the capital that you're making today. And if you do nothing to invest it, then you're not going to be able to spend the same as you are now as inflation compounds over time. I talked about health insurance, or excuse me, health care and shelter, or housing, both going up. They're both going up at 3 to 4% clip. So if you want to have a house and you know, health care, then it's likely beneficial to invest in some way, shape, or form, or stay invested to try to protect against those things going up and be able to pay for those things in the future when you retire. There's asset classes that try to help you with that. Treasury inflation protected securities, or TIPS, can add inflation protection. There's commodities that are somewhat able to do so, but they have volatility. In addition, infrastructure, and then just equities. So stocks over time and in inflationary environments have been able to provide returns in excess of inflation, so you've gotten a real return. So these are things that, you know, if you're thinking about investing longer term and you think about what you're going to spend in retirement, staying invested is key, at least for your retirement accounts or things that have longer term time horizons. So with that actually wraps up my prepared remarks. Is there any questions?
Yeah, thank you, Matt. We appreciate you sharing your time and knowledge with everyone here today. Like you said, we'll now start addressing some of the questions that have been filtering in through the Q&A tool. And remember that if you do have any questions, you can continue to submit them using the tool on the webinar menu. So let's see here. So we have a question here. If I'm currently invested in bonds, is there anything I should do if interest rates rise?
Sure. So the first thing I'd say is it depends on how fast and by how much interest rates rise in your time horizon. So I would say that if interest rates rise at a very slow pace and modestly for the next year or two, and you have a long enough time horizon, expect it to kind of trim your returns, but that you really shouldn't do much in terms of changing your asset allocation. That it's not going to be a meaningful impact. Now, if you do want to take some of that interest rate risk or the potential for bond prices to go down as a result of interest rates rising, there are asset classes within fixed income that can be beneficial and that tend to be less sensitive to interest rates rising. One of the ones that we have found attractive in that kind of environment is this asset class called bank loans. Bank loans, they're often offered in products, mostly there's active strategies, but there's also passive ones. The other thing you have to consider when you are looking at those kind of strategies is they do have credit risk. So they are able to, they have very low sensitivity to interest rates rising because they reset frequently, and they just don't have a lot of duration. But they are lower credit quality. So I talked about, there's AAA is the highest credit quality, BBB is your investment grade kind of end of the line, and then it goes all the way down to B, which is below investment grade. Bank loans tend to be below investment grade. So in like a 2008, they dropped significantly. So unfortunately, there's no free lunch. We would add to your portfolios in a prudent manner with bank loans, considering the risks, but they can be a diversifier away from, let's say, investment-grade corporate bonds, which tend to be higher quality, but also have higher duration risk. So if you put those two together, you're getting a mix of lower duration, but lower credit quality, and higher duration and higher credit quality. So I hope that answers or helps with that question.
Yeah, great, thank you. And then one more I think we have time for here. So someone asked, should we be concerned with Brexit's effect on the global economy over the next few years, and what can we do to help mitigate these effects?
Sure. No, I think the Brexit effect, if you will, has not fully played out in that they had a vote June 23rd to leave Europe in their trade relationship there, and yet they hired a new prime minister, but then they did not actually trigger Article 50, which is the document which would really actually have Brexit go into effect. And they haven't had that happen yet. And so that is still on the table of when that's going to be. January is what we are hearing as a possible time where they're going to enact Article 50. What is that going to mean to investment portfolios? So one, we would say that the currency element is going to be important. The only thing is that the pound, the UK currency, has already dropped significantly. It's dropped over 10% this year. It's down to about 1.3 versus the dollar. So if you want to go to the UK on vacation, it's actually relatively cheap there compared to where it's been. So some of that in terms of the currency might actually be somewhat priced in. Now, can it drop more? Absolutely. It could go to parity with the dollar, and you could still see more downside pressure. The other side is the equity market and global economy. So the UK market, the UK economy is about the 5th largest in the world. The thing is that a lot of those companies tend to be global multinational firms. So these are companies that do business all over the world. They just happen to be domiciled in the UK. And they actually benefit if the currency weakens. So from a company perspective, you could say that the trade relationships and the regulations could be a hindrance on their business. And you might see them move around. You might see their, they become domiciled in another country. They could move their offices. So some of that could be a problem. But nonetheless, it does seem like it is going to work itself out, and that investors, being tactical around it. I think the Brexit vote alone gave us a learning lesson that, switching your asset allocation around a event, as soon as that happens, it's priced in within days. And if you sell or reallocate beforehand, it's at best a coin flip. And afterwards, you already lost, in essence, because you're selling into a very illiquid environment where you're not getting a good price on those assets. And so our view would be to think about it as a longer-term investment, that international equities are still going to have strong businesses that are going to make their way through this, and that you still do want to own fixed income as the ballast of your portfolios, so that in the case that there are these shocks to the system, you've got a piece that is going to be well insulated. And bonds in Brexit situation did very well. Treasury bonds rallied, corporate bonds rallied, international bonds rallied. So you want some of those assets that will actually go up if stocks fluctuate. And then, at the end of the day, if you're holding on for a 5-year time horizon, we think it'll all sort itself out. So a couple things to additionally consider in terms of Brexit.
Great. Thank you so much, Matt. That will conclude this webinar session. Thank you all attendees for your participation, and I hope everyone has a great day, and we look forward to seeing you at our next webinar series. Take care.